Okay, it's a great pleasure to welcome all our panelists and participants from here and around the world to this very special webinar put together by ASA. And the top headline is Anti-Africa Bias, the Presumption of Risk Color Investments on the Continent. We thank every one of you making time to be part of this, and I hope we're all keeping our social distancing. I have four panelists, and I'm grateful to have them to speak to this very important issue impacting on Africa. Let me start with Fulu Mudau, who is a fixed income and currencies officer at the Deutsche Bank in South Africa. Fulu, it's good to see you.
Thank you. Thank you. Glad to be here.
Thank you. And I'm just going to talk say welcome to Christoph. Christoph Charlier, former chairman of Renaissance Capital, a man with a very heavy bio on the street when you talk about currency, investments, risk management, making sure deals happen on the African continent. Thank you, Christoph, for being a friend of the continent. And then Michael Nderitu. Michael,
pleased to be here.
Officer for ASA, and he's one of those who understand how the market works on the African continent. And finally, Kojo Annan, the man who is holding the torch of the great Kofi Annan, a former Secretary General of the United Nations. Kojo, it's good to see you. Thank you very much.
Thank you. Pleasure to be here.
Kojo is an entrepreneur and investor, and he also understands deal making on the African continent. We thank everyone for being part of this webinar. Let's just talk about this. My first thought about this has to go with this question, and I want us to think about it while I put up the poll first. But the question is Africa guilty until proven innocent, or innocent until proven guilty when you talk about presumption of risk color on investment? So how do we discuss this? Just a quick one here. What is our poll for the day? And we have a very, a question which we want our participants and our panelists to also take a time to just give us their sense of what they want. To what extent, and that's the question, to what extent is there a sense of risk bias against Africa? Investor bias is limited or not existent. Investor bias is significant or justified by poorer fundamentals, or investors bias is significant and cannot be justified by the fundamentals. We hope everyone will vote, and then we'll take, I can see folks are already voting into the polling. We'll bring it up again while during the discourse, then we will talk more about it. Well, thank you very much, everyone, for coming through on this program today. I'm Boston Amofai, and of course, I work with new media and markets intelligence with Gavin and the rest of the team at ASA. So when we look at Africa vis-a-vis other regions of the world, we look at Argentina in Latin America. Argentina has been a very notorious defaulter. We look at oil-rich Angola in Nigeria. You look at Mozambique recently. Then you look at the history of HIPC for Africa, which was the highly indebted poor countries during those years. So we want to probe the risk bias against Africa as the continent steps forward and begin to make debt negotiations with the G20, with the World Bank, the IMF, and with the Chinese on the other hand, and everyone else in between. So this is a very interesting conversation, and I want us to get this started. So I'm going to throw this general question very quickly, and I'm going to ask Fulu to start. Is this a guilty until proven innocent, or a case of innocent until proven guilty?
Thanks, Boyson. So I don't know the answer, but I would say what we need to look at is what are the narratives that we're seeing in news media about Africa? And particularly if we compare those narratives to what we see about other emerging market regions like Asia or LATAM, for example. You know, I've seen a lot of reporting around Asia being a great investment story, you know, a lot of articles motivating investors why they should put their dollars there. I haven't really seen the same on Africa. So I would say, what are the storylines that we tell ourselves about Africa? What is being reported about, not just in the news media, but also around the systemic and political infrastructure that we have here? What are the stories? And do those stories tell a good investment story or not?
Well, I'm interested in this story again because this morning there was a news item credited to Tanzanian President Magufuli talking about a $10 billion Chinese deal for port and economic zones. And he says, quote unquote, only a madman would sign that deal.
Yeah.
When you hear comments of this nature, Michael, what comes to your mind about how we do deals in Africa? And the default risk premium that investors will be asking for, is it justified therefore?
Yeah, so if you look at, yes, there is a bit of biasness in terms of investments in Africa. And if you look at globally, Africa countries are not borrowing as much as our other counterparties in developed countries, probably even borrowing close to around 40% or 60% thereabout of their GDP. Well, developed countries will borrow probably higher than 100% of their GDP. But the key thing is they are paying so much interest for that debt. Reason being, could it be about media, as what Fuju has just said, or it's just about high transaction costs for doing business? Is it about lower infrastructure? Is it about poor government policies? Yes. So those are key things that always will affect that. And also not forgetting, in the same competition with the sovereign bonds. So we also have to give a higher interest on the bonds that we are looking for. And then that is a bias that the investors will come to look for, because they will come back demanding that they need higher premiums. And they also require that because of the dollarization effect, meaning whatever they plow in Africa, once they want to get it out, they'll be experiencing dollar shortage, because every dollar is a scarce commodity in Africa. So if you load up all those premiums, you'll see that there is a bit of biasness in when we are trying to do a lot of investment in Africa.
Christoph, what's your take on this when you look at what Renaissance Capital has been able to do across the continent in terms of some of the deals you've been involved in? What are some of the key issues that investors are concerned about? Yes, there's a dollar liquidity. When you're dealing with debt, for example, on the sovereign side and at the corporate side, what was the sentiment? What's our sentiment around the default risk premium? What is the top on the table here in terms of concern or in terms of bias against the continent?
So thanks for the question. And building on what Fula and Michael have said, it's not as much a default premium as a laziness premium, right? What you need to remember is investors are lazy. They like countries and companies that return to the market frequently, so that when they do spend the time to do their homework on a particular issuance, that they get the chance to use that the following year and the year after several times, right? That's an issue when we did, for example, the IPO of Helios Towers. We had to go and educate investors about Tanzania and the DRC, which are the two big countries for that company. A lot of investors told us, listen, DRC, Tanzania, I'm going to spend a lot of time understanding the politics, understanding the economy, understanding all of the, capital controls and all the other issues in those countries. But I'll do that only for one issue. It takes too much of my time. It's just not worth the effort. So that's a big issue, the laziness of investors. The second thing is, liquidity is king, right? When investors invest in a bond or in a stock, they want to know that it's easy to get in and easy to get out. If they see that they've made, a wrong call, or if they want to capture the upside that they've already gathered, they want to know that they can get out quickly, that there's a secondary market, and that the capital controls are in place. Another thing I would say is, size matters. For a lot of investors, it's just not worth it, to spend all the time looking at it, Eurobond coming out from one of the smaller African countries, and then to get a 5 million or a 7 million allocation on the bond, when, for them, unless a ticket is 50 million or something like that, it's not worth for them doing the effort. To continue on some of my catchphrases, and, sorry for that, but, investors love catchphrases. I would say, misery loves company. And what I say by that is that so many investors, to go back to the Argentina story, know the risk with Argentina. If something happens, all of the investors will get together over a beer and say, Argentina did it again. And they'll all feel okay because all of their friends will have been in that and all of them will be suffering equally. If, one of them takes a risk on one of the African countries and the deal goes south, that person will have taken that risk alone and then will need to justify to their investors, to their bosses, and to their investor friends who will say, why did you even bother looking at that? And then what I would say is, there is always a strong home bias for investors, right? So investors like to invest at home and then regionally. And typically, in order to justify going very far from your home region, there needs to be an understanding of a couple of things. Is it worth diversifying the risk? Are you lowering your risk by diversifying? And are you increases the chances on yield? And on the reverse side, what investors will do is they will look at a country, let's say like Argentina, where there is an existing domestic investor base. There's a very large investor base coming from its neighbor country, Brazil, which is also invested in Argentina. The U.S. obviously, looks at Latin America as its regional, as its region of interest, so they're quite active there. Unfortunately, in Africa today, there is not much of a local, domestic regional market that investors can look at and say, well, if Africans are investing in Africa, then I can do it as well. They're more looking at and saying, well, look, even African investors aren't looking at Africa, so why should I?
Interesting, Crystal. But again, at the back of all of this, and I'm coming to you, Kojo, in just about a second, that we need data. In other words, you don't do investment. No one does any investment without data. So this morning, I had an email exchange with a gentleman in London and asking for to do a bit something on Africa's Sales Managers Index. And he says, look, we don't publish it anymore. And that's why. He said, no one was interested about it. So, but you have the US Sales Managers Index out today by World Economics. And I'm saying, can I get something on Africa? I said, look, I can talk about it. We stop publishing it because nobody wants it. So why is it that nobody wants this data about Africa? Are Africans themselves interested? Are investors interested? Kojo, are you interested in data that will help you navigate the risk on the continent rather than, when this data are compiled and put together on the continent, rather than being done offshore, without no boots, without outside where you can put the boots on the ground? Kojo.
Sorry. I think my internet was being a bit unstable, so I didn't hear your very last point. Can you repeat that?
Yes, I was asking about the importance of data when you're doing investment. As an entrepreneur, and you're looking to make deals, whether you're talking about FX or you want to do debt on the corporate side, how critical is data in terms of the risk bias, punching a button, and you had all you want about the continent, either on a country basis or on a region basis?
Yeah, thanks. I think data is important, but I think it's all still interlinked with the earlier points made by Christoph and Michael and Fulu. So if the narrative is already biased, then many people aren't even going to go delve deeply into the data to either justify or not their investment, because they've already built up a picture that's been told to them that Africa has all these inherent risks. And I think you could even go a step further and say that, the game has already been created in a biased fashion against you. So you're playing a losing game before you start. So again, using the point Christoph raised, if I'm doing a bond investment or something of that nature in Africa, and I'm looking for interest rates of a much higher interest rates than would be applicable in the West, then already you're on a losing footing as the African before you start. Because I'm a government, I'm borrowing at 8%, 10%, 12%, and another guy is borrowing at 0.5%, 1%. Where's the equity in that? So before we even start, I'm already on the losing footing. And I think, these are some of the fundamental issues that have to be addressed. And because these things happened historically, it does not mean it cannot be changed, because we can't spend another 20 years, 50 years, 100 years playing a system that doesn't work. So I think fundamental change is required, as well as the narrative, as Christoph said. People many years ago, Colin Powell told me, money is a coward and it likes to go where it feels comfortable, and it likes to come and go as it pleases. But also the money likes to be in surroundings that it understands. So until more and more investors understand Africa and have changed their biased narrative, then you're fighting against a glass ceiling that's very hard to break through.
Thank you. So let me ask you, Fulu, is this prejudice political in nature? Is it market? Is it based on economics? Again, we've not seen very serial default on the continent. Of course, Nigeria repackaged its debt portfolio in 2006, 2007 with the debt forgiveness with the Paris Club and what have you. Then we had a history of the HIPC. Are we dealing with a legacy prejudice here, or what exactly? Where did this come from that is so fundamental that it becomes entrenched, that it becomes very difficult to shift the mindset for the big guys with the big pockets in Paris, in Frankfurt, in Brussels, in London?
Barton, I think it is a legacy issue. However, it's still continuing currently. And, I agree with Koja that this is something that we need to change and we can change. And this comes back to your earlier point around data, because, for example, one of the data sources that we use to assess investment in Africa is rating agency reports. Now, from what perspective are these rating agencies reports? What the methodology that they're using, is it appropriate for Africa? And do they really understand African politics, which counts a lot in that rating? So, I think although there is a legacy issue and historical factors, and of course, I think, Christoph, you touched on it in terms of market development, there are facts that, a lot of the countries in terms of market development are not where they should be, and they're not where the rest of the emerging market economies are, particularly when it comes to fixed income investment. But when then it comes to the narrative, I think that is something we can change. And I think rating agencies play a major role in that. I mean, we've seen in the past few years, I think the likes of Zambia, Tanzania, maybe have questioned the outcome of their ratings and said, they weren't adequately consulted and there's a misunderstanding of the situation that's happening. So if our data sources around the systemic issues and the actual situation is from offshore, if we're not telling our own stories, then how do we even start to change the narrative?
So, okay, so Michael, this is a hypothetical situation. This is Mozambique. Has defaulted on its Eurobond, and then here is multi-billion dollars going into the NLNG Mozambique's projects. Total is putting about $15 billion on the table. Afrexim announced about $400 million. Overnight, the U.S. Export-Import banks talking about $4.7 billion US dollars. I did a simple math. That's about 21 billion US dollars. So, is this biased? Then you look at Nigeria, on the other hand, which also has a very vast gas field and what have you, but it's not getting any serious dime on the table.
Yeah, that's true. So I think that's a very open bias, and this affects our economies. And really, you have really mentioned in terms of debt, Cape Verde, Djibouti, Congo, Mozambique. If you look at their GDP to debt to GDP ratio of around 60%. And then you also look at the other developed countries and look at the
Michael? Okay, I think we lost Michael there for just a second. Christoph, how would you weigh in on that, on this hypothetical or this situation that Michael was talking about?
Well, this is the issue, going back to what I said before, right? If Mozambique defaults on a Eurobond and you hold that bond, there is very little liquidity on the secondary markets, and it's very difficult for you to get out of that paper. Whereas in some of the other emerging markets in Asia and Latin America, there are, bottom fishers to whom you can sell that. Now, okay, you're going to lose money on that. You're going to leave money on the table, but at least you can get out at a certain, reasonable number of cents on the dollar. And so that's, an issue for investors coming in. Going back to what I said before, you want to be able to come in easy and get out easy as you can. To, on the point that Michael was making as he got cut off, looking at total debt to GDP as a way to look at the health of of an economy relative to other countries, I think is a little bit misleading. And it is because the fiscal collection of countries are different, right? So countries where the tax regime is properly maintained, where there's, less of a gray economy involved, you will have the fiscal purses will be richer. And therefore those countries can borrow safely at a much higher percentage of GDP than other countries. And then second, the different rates of interest, right? So if you're at 60% of your GDP, but you're borrowing at 2%, that's better than being at 40% of GDP and borrowing at 6%. So it's important to keep all these things in consideration. Saying that countries like Nigeria have a low, percentage of total debt to GDP, can be a bit misleading, and you need to look a bit behind the numbers a bit.
So, Kojo, do you think Africa has been badly impacted by this bias when it comes to the demand for risk premium, the appetite for the country's debt on the global space, what international investors want? They want good currency, they want liquidity of FX when they want to exit, either at the sovereign side or on the corporate bond side. Do you think Africa is coughing up much more of its revenue, scarce revenue, to pay on this debt obligation?
Sorry, it went a bit unstable in the last question. Your last point about the scarce revenue, I didn't hear that well.
Yes, about how much Africa is paying and how much impact has this risk premium, default risk premium sentiments and what's called bias, if you want to put it quote and unquote, on the continent. How much impact has it done on government finances and revenues that should go into healthcare, education, water, the basic human development items that the country keep chasing after all the time? At what point do you think something needs to happen on the positive side for the continent?
Yeah, and I mean, I think, your point is totally correct. And of course, I think it has a massive impact. I think Christophe touched on some of the points earlier. If an African country is paying rates, 4 or 5 times more than the rest of the developed world, then, the business fundamentally, you're already at such a huge loss before you even start to try and get a return on, whatever you're using the bond or the funds for. So before you even start, you're already at a loss. And as he said, so regardless of your percentage to GDP ratio and everything, just on the rates at which you're borrowing, you're already at a loss. And a lot of these rates and these charges are placed on historic biases of the view that, oh, these countries will, as you said, default, or the projects won't work, or I guess the economic or financial sophistication is not there in these markets. And these are narratives that have been pushed for decades and decades and keep getting pushed. And we all know that today is simply not the case anymore, because there are so many Africans who have the same skill set or more of anybody in New York or London or Paris, and they've been to the same schools and been to the same universities, and they can talk the same jargon. But as Christophe says, it's also linked to some sort of broader old boys network, where if we're all sitting in London or Paris and I say, oh, I have a friend in Buenos Aires or Rio de Janeiro, and we all know each other, we're all friends, and then the investors tend to have more comfort around the markets that they know and understand, and because they historically don't have relationships with Africa, these biases keep getting perpetuated, and this is the narrative that we have to break. And to answer your question, I think that has to be done yesterday.
So when we look at this risk premium from investors on the outside, lenders, then you look at the domestic environment in terms of interest rate. Fulu, do you think there's a bit of a connection here in which you have cheap money or cheap funds are very scarce in a number of African countries or economies to invest in by entrepreneurs to lend to SMEs, women businesses, and what have you? Do you think it's a bit of a corollary here in which the risk premium from outside is so high, and even within the financial systems in each country within Africa, rates sometimes are so exorbitant, almost impossible to be obtained by local entrepreneurs who want to build businesses and increase local production and create jobs locally and all of that within these different economies?
Yeah, absolutely, Buzz, I think so. I mean, in the private equity sector, for example, you often hear that there's too much money and not enough assets, not enough fundable projects. But when you delve deeper, you actually find that there are projects that are fundable. However, that money is requesting a very high premium, and the targeted IRR is so high that they're not able to meet each other halfway. So, it isn't the case that there aren't fundable projects and there aren't good sustainable businesses that investors can invest in. The reality is that the high target premium simply precludes any meeting of mind into that, and then creates this perceived gap that there isn't the funds and there isn't the investable projects, when in fact it's actually the problem is the rates and the premium that investors are requesting to put their money in Africa is simply too high.
Okay, good. But again, here we are at a new destination of debt relief discussion under the coronavirus pandemic environment. Crystal, how do you think Africa will be able to navigate this very tense environment we found ourselves with Nigeria having the knife here, like the sword of the Damocles? The authorities in Abuja, for example, says we're not asking for any rescheduling of our repayment. But again, if you look at the fiscal balance sheet of the government, there is not enough to pay even this debt. So I don't know how to put it, but do you have any idea how this African economies can navigate this? Look at Angola as well.
Yeah. Well, for many African countries, if you remember my earlier comment, this is the COVID is a perfect storm. Those countries, but like Nigeria, have a large percentage of the economy is still gray. There's no social safety nets, to protect unemployment and things like that. And fiscal collection is nowhere near where it should be. So for countries like Nigeria, it's particularly hard. But my sense is, what we should be thinking about in this conversation is what do each of the countries do in this situation in order to create the capital markets that allow them to be able to raise money, to be able to invest at reasonable rates in the future. And for me, when I have these discussions with central bank governors and decision makers in different countries, my recommendation is always, you need to invest in developing the domestic capital markets. You need to have local pension funds. You need to have local mutual funds. You have to have the insurance companies and banks encouraged to invest and to promote the real economies, not just buying, government bonds and trading bonds and all of these things that they tend to do, but investing in the real economy. Countries like South Africa, the PIC is the largest investor on the continent. The fact that has been, not managed, I was going to say mismanaged, but it really has been not managed in a way that the PIC has been, completely not present in the African capital markets now for, months and months and months, and, starting to look like years, is not helpful. You know, in the past, on a lot of IPOs that we've done, PIC has played an important role as an anchor investor, right? Whether you look at Kengen, you know, we Renaissance Capital back in the day, we brought them into Dangote Cement as you know, as an investor to prepare for entry into the capital markets. We had them come into Siplacusil out of Uganda. You know, they play an important role in the markets, and the fact that they're not present these days is extremely unhelpful. You know, so my recommendation would be these are tough times, but let's build for the future, and let's develop the domestic markets as much as we can, because you know, as Fulu was saying, foreign investors will look for big risk premiums to make it worthwhile to get out of bed to look at African paper. But local and regional investors will require less of a premium because they understand the risk, and they will have what I referred to earlier, the home bias. They understand the economy, they understand the politics. If the proper instruments are in place, they're, you know, they should be the backbone of the capital markets, not foreigners.
Understand this, but again, Fulu, help me to make a sense of this. We'll take questions from our participants, but just a quick one. Look at Nigeria. We keep saying foreign portfolio investments coming through to the economy. This is your foreign direct investment at the bottom of the barrel, as it were. We're doing about 250, about $500 million or less for 200 million population, an economy that needs more than $100 billion in infrastructure investment. So foreign direct investment almost getting to ground zero, and there's some foreign portfolio investors also coming into the country. What's the difference here? Why is that so?
Sorry, Bosan, I missed the last section of your question. Please repeat that.
I'm trying to understand, and my question was, foreign portfolio investors seem to enjoy the Nigerian marketplace. But again, when it comes to foreign direct investment, this is getting dried up.
Okay. So I think this ties in with what Christophe is saying around developing a local market, right? Because portfolio investments are really liquid, right? This is fast money that comes in and out. And as long as a country, really, you provide a mechanism for these investors that they feel secure that when they want to get out, they can. And on the other side, you have local asset managers investing into the market, then you should continue to see foreign portfolio inflows and outflows, right? So whereas for foreign direct investment, I mean, that is a more long-term play. That's where now, you know, it goes into, you know, the narratives, and do you really believe in the long-term prospects of this country, and are you in it for the long haul? Because with FDI, if you change your mind, you can't suddenly get your money back, right? That is a very illiquid investment. But in the portfolio in the portfolio markets, you can get in and out. And you know, I really want to stress again what Christophe was saying, because I think particularly in the South African market, that's what we've seen as well, where in the domestic bond market, because there is such a huge portion of local asset managers that participate, this actually drove international investors to come back. So, you know, during the pandemic, we saw a bit of a panic from international investors, but they saw the local market consistently buying and supporting the SA government. And so they came back. So that was an indicator for them that, okay, so if the local people are investing, then surely there must be a good story there, you know, going again with this herd mentality where you want to invest, where you can see other people investing. So I think that is the case as well. You know, across all our African bond markets, we need to strengthen the local institutional community, asset managers, pension fund. Let us ourselves invest on the continent. Then we can then say to outside investors, okay, you can come in as well. See, we're also here.
Your money where your mouth is, and your mouth where your money is. Okay, so Kojo, I'm going to ask you, we need to go to, thank you.
Yeah, can I just add to thing?
We need to take some questions now from our participants, and they're coming in torrents. So I'm going to be a little bit biased to the first question around currency. Intra-Africa trade, the AFCFTA, whatever. So this question from Michael Atolabe is asking, why can't we trade without the dollar on the continent?
So to answer that question, yeah, and that is what, as AZA, we are there to try and sort out, because we really have also been impacted with the dollarization effect and the cost of the accessing the dollar liquidity. But if you look at it, Africa is a victim on its own because of the vicious cycle. Who do we order from? So you see that we order from Hong Kong, we order from China, we order from US. And these guys, we cannot settle them with your local currency. So they will need to do that. Africa governments are very good in having trading blocks, but they don't follow, they don't coordinate in that. They don't make sure that other than the trading blocks being in operations and just doing a press conference and having that, how do they make sure that these trading blocks really work? Because until these trading blocks really work, to ease our ability to coordinate, ability to ease business, if you're in Uganda, Kenya, or Uganda, or whether you're in West Africa, that is when it will be able to kill the dollarization effect, so that we can order locally ourselves and we can do the trading partners ourselves. But as long as the trading patterns remain to the US, to China, we still have to settle them via dollar. So it's up for us and to help our governments to be able to initiate the trading blocks and make them work perfectly well, and kill the cumbersome investment requirements and the legislation process. Because yes, there are trading blocks, but within that, the cumbersome investment, legislation, the procedures for you to do business is unwarranted. And because you're in the competition with somebody who can easily import from China, and you want to import locally or from our neighbors, what do you do in business? So you have to put the money where the mouth is. So you'll have to go directly to China. But if you can sort that out, I think that will be fairly done.
Well said. There's a question from another participant that's very close to what Michael just spoke to, and I'm directing this to you, Kojoanna. In terms of Femi Awotole, the question is that what role can enterprising population play in guiding investment decisions apart from risk assessments of an economic ecosystem? I'm now talking back about the local economies and local markets.
What role can enterprising populations play?
Yes, play in guiding investment decisions. You're an entrepreneur.
Yeah, if I probably understand the question, I think it's just further building on the point Michael and Christoph made, but Corona and COVID provides a great opportunity to the continent. In my opinion, it's time for us to actually do a complete reset, not to go back to the way the system was. It's time to reimagine Africa. And I think AFTA and the free trade agreement is central to that. And touching on the points that Michael and Fulu need, until we start building up our own local enterprise and trade with ourselves and take control of our own self-determination, self-demonstrated, when push came to shove, we were on our own. Nobody was coming to bail us out when they thought we were going to die in the millions. So if that's not the wake-up call for the continent, I really don't know what is. And it's about inter-African trade, developing those economies. As Michael was saying, with technologies now, there's cryptocurrencies, there's so many other digital leapfrog transformation technologies that are coming in the coming years. It enables us the possibility to reimagine this whole economic structure of the past. And I would like to just point out another fact. If you take the fact that the United States in the past 3 months have printed something like $3 to $4 trillion under the guise of quantitative easing, and meanwhile, that is the whole GDP of the continent of Africa. They've printed that in 4 months under quantitative easing, and we're still here as a continent of 1.3 billion people begging for debt forgiveness. Clearly, something is wrong, and it requires major fundamental change for us to actually take control of our futures. Because, as I keep emphasizing, the system today, as it is broken, and it just simply cannot work for us. So I think it really takes bold transformational change to work out future steps so we can determine our own future.
Yeah, to build on what Kojo was saying, and it's a point I've developed in other forums. COVID has been such a drastic effect on, not just the African economies, but also the European and the American economies. And those countries now are rethinking their supply chains, right? The massive reliance on manufacturing coming out of China. Countries are realizing that that's no longer, a safe and efficient model for them to build on. And this creates opportunities for countries like Morocco, Egypt, that are already, industrialized, that have an educated base, that have, the ports facilities and the industrial facilities and all that, to really position them as an alternative to manufacturing and imports coming out of Asia. I would put Nigeria also in that basket, not as much for the industrialization, but just for the massive workforce that can be used for some of the manufacturing that's been done out of China for the last decades. So this is an opportunity really for certain countries in Africa to really benefit from supply chain modifications that may come out of the COVID situation.
Thank you, Christoph. Just a quick one here. Elliot Smith of CNBC has a question, and I'll try to summarize it. And he was talking about if it is fair for the West to continue with a tendency to view Africa as a singularity rather than a continent like Europe as well, with many countries within the EU. Then you have the African Union with 54 countries on the continent. So he's trying to find out if there is a justification at any point for risk aversion and where it may be overblown, like we're now trying to go on a country basis, or region and a region, north, east, west, and southern and central Africa, rather than taking Africa as a country when we're trying to do our risk assessment.
I mean, I think on the question of whether it's fair or not, I would look to other continents. I mean, do we take Europe as a single country? If not, then why would we do the same on, for Africa? Do we look at Asia as a single country? If not, then why are we doing the same for Africa? And I think this plays in also into what Koja and Christoph were saying, where the world now is so interconnected post-COVID. It presents a massive opportunity also for us as African to say to the world, well, Africa is not one country, and Africa is not two countries either, which is like North Africa and Sub-Saharan Africa. Each country has its own unique characteristics and deserves to have its own platform. Absolutely, that's my opinion.
Okay, so Michael, let me ask you this very quickly. One of our participants asking the question, to what extent do you think sovereign credit risk ratings inform risk pricing to investments made to the private sector in Africa, whether it's from Fitch, from S&P, from Moody's? Do you think they sort of impact how investments are considered when it comes to private sector in Africa, whether there's a private equity or whatever, or venture capital?
Yeah, that's true. That's true. So the pricing of whether it's equity markets in Africa, that is very, 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 very critical. And as Christoph said, please note, our offshore investors, they are very, very lazy. And these are the guys that when we look at who do we blame for this biasness that we already have here? One, they are investment banks, because they put very fewer analysts to focus on researching on African companies and African companies, because most of them, they may be smaller in size, so they are not big ticket. But these guys have not really looked at how they can really support. So the investment banks have then not put that on that. The other second thing is investors lack of spending on the ground analyst and investment professional in Africa to try and understand how they can manage and mitigate risk and understand the risk assessment in Africa is maybe very difficult or different from the likes of what they are doing there. So they may just rely on very biased ratings from S&P, Moody ratings, and what have you. But that adding to what Fulu had said earlier on when we were beginning, that Western medias have a biggest bias in Africa, where some guys, when you happen to travel abroad, when you tell them you are from Africa, the guys are also a bit perturbed. They think you're coming from a place where it's a hopeless continent and you have never seen a skyscraper. But yes, what we are coming from is we are very developed. We have learned guys, we have investment banks, but just lack of people putting the money and understanding the credit analysis of African markets. Because risk, you can never have a global risk. So risk assessments depend, they have so many other variances that you have to put there. So until they will come and the likes of international ratings come and understand that they have to do that. Number two, these guys don't put the economic growth averaging out in African states. So they really try to shy off from that, but they only put the rating first. If something goes bad, poop, that's the number one thing. But they don't put the GDP growth, they don't put how much the venture capitalists that have invested in Africa, how they have turned out to be. So those are things that I think they really need to look out for.
Thank you. Kojo, I'm just coming back to you very quickly. Agnes Gital has a question about startups in Africa. How do we encourage local capital to African startups? Again, how do we get regulators to step in to protect vulnerable African startups from aggressive acquisitions or mergers by the big boys from the Western world, the Western economies? Do you have any idea around this? The question from Agnes?
Yeah, I mean, I just give my view. I think it's a very good question from Agnes. I think it touches a bit on what Christoph said. You know, the local banks, institutions, markets need to support the local entrepreneurs. That's the only way we're going to grow. The entrepreneurs have the problem because if I have a project in Nigeria or Ghana, I go to a bank and, you know, they're offering me crazy interest rates. So this self-perpetuating cycle keeps existing because of the entrepreneur. If he takes a loan from a bank locally, he or she takes a loan from a bank locally, the interest rates are sky high, and from day one, it's killing your business. So then you now have to start looking for potentially outside investors that can give you, you know, potentially cheaper money, but then they're going to take an arm and a leg. So I think you have to get a fund, as Agnes, I think, has pointed out in her question, protect the local entrepreneur or investors, somewhat similar to what you see in some countries like India, and obviously slightly more aggressively in China. But there needs to be some sort of protection for the local investor to enable them to compete fairly with, you know, this potential issue that she has raised.
Now,
I think it's a fine line because you don't want to scare off the international VC, but you also need to create an enabling environment that protects the local investors and allows us to grow. So recently, you've probably seen in the news, I mean, I wouldn't call him a startup, but you've seen so much money pile into India, into Reliance and Jio's, the new telcos, because they had nowhere else to go but to the local guy, because the environment in India had been created in such a way that, you know.
So what about the fintech space?
He was favored.
Thank you, Kojo. Just a quick one. Let me just ask Apollo about the fintech space. Do you think we need more regulations here? Fintech has been identified as the way forward. We need technology to resolve a number of issues on the African continent, from e-governance to the banking, financial services sector, to industrialization, to SMEs, even to healthcare during this pandemic, in terms of how to deliver drugs or vaccines or whatever to very remote areas. So we need fintech here, we need technology here, technology companies here. Do you think there's a space for these startups on the continent under this risk premium default mindset environment?
Absolutely, boss. And I think fintechs are an exciting space and they hold so much potential in so many various sectors. Healthcare particularly, I think, is where they can play a huge role. And in the banking and investment services, there are a lot of gaps there, and there's a lot of need from retail and business customers for services to be cheaper and faster, and fintechs can plug into that hole. But, on the regulation side, I think you raise an important point there, because I certainly feel like our regulations are constraining fintechs to grow, and the regulatory framework, for example, particularly in the telco sector and the financial services, it actually doesn't allow a fintech to grow and compete properly with established legacy institutions, right? The regulation it's done in such a way that the fintechs are still dependent on these legacy, huge telcos and banks that we have. So definitely we have an opportunity now to revise our framework and make the legislative environment such that it encourages growth. And, this will also help on the investment side, because if you're an investor looking in at a fintech, even if it's a wonderful idea, if they can't implement it because of a regulatory roadblock, then that's not going to fly. So that is definitely an area where I think it's a massive opportunities for, African regulators on the continent to look at and say, well, how do we optimize this? We have this wonderful opportunity, and we've got so many brilliant entrepreneurs on the ground on the continent. How do we pave the way for them so that it's easier for them, to actualize those businesses and deliver sustainable solutions for people on the continent?
Yeah, sorry, I just want to add to what she's saying, that you need to also ensure that the regulation is cross-border, because it comes back to Christoph's earlier point. Otherwise, if I'm a fintech operation in Gambia or Togo or some smaller countries, you don't get the economies of scale. But if I'm an investor, I don't want to keep having different regulations, across each region. So it'd be good if they could have some consistency, at least across certain economic blocks.
Yeah, and if I can build on that as well, if you look at the constraints of, transactions within countries and across countries in Africa, obviously financial payments is a big issue. So this is a massive opportunity to really leapfrog certain technologies. I don't need fintech in France where I'm right now, because I have a bank account, I have a credit card, everything works fine, right? There's a low level of bank accounts in cross Africa, so people can use their mobile phone because there's a higher level of mobile phones. These technologies, the regulation needs to be put in place, both stick and carrots, to encourage the development of fintech, both in terms of digital banking, right? To facilitate B2B and B2C, but also in things, I was mentioning earlier the problem of tax collection in many African countries. There are some technologies, and one that comes off the top of my head, a company called Mobivat, that has developed a technology to effectively and in real time collect VAT. And if you can put in these technologies into countries and in regions, that facilitates tax collection, that facilitates transactions. It allows economies and companies to grow much more swiftly. So I'm a big believer in the importance of fintech as a solution for Africa's problems. And again, it's something where, African minds and African technologists and entrepreneurs are the best place to be resolving these issues.
Yeah. I have one big question, which comes from one of our viewers, and is the big elephant in the room. Morungi Oponyo is asking the role of real politics in play in countries. Look at Argentina and Angola, for example. Is it reasonable to assume it's not an entirely economic decision? So when risk premium is being decided upon by investors, we're looking at Libya, looking at the face-off between Ethiopia, Sudan, and Egypt over the $4 billion hydroelectric power and the Nile River Dam. And you're looking at the political situations coming through in Ivory Coast. Mali, they're yet to resolve the issues. In Tunisia, some folks turned off the oil flow station a few days ago, last weekend. The prime minister resigned. Then you have the Ethiopia internal crisis. So what role do you panelists think that politics will play in terms of deciding the risk premium and the bias against Africa when it comes to investment decisions and the premium that investors will want to see them put on the table? Let me start with you, Fudu.
So unfortunately, politics plays quite a huge role. So, I mean, even if we look at the rating methodology of like your Moody's, S&P, the big rating agencies, policymaking institutions, you know, what the popular press is saying around politics and their own misunderstandings of the situation, that generally counts for like 30 to 50% of the rating. So that is a huge chunk that is assigned to whatever is happening in the country. And I think for me, I don't think it's a bad thing that politics is, it counts in the risk premium. I think what the unfortunate circumstance is that there is such a wide misunderstanding of what is actually happening on the ground and what do these events mean for policy and policymaking institutions, and do they actually translate into a worse economic situation or not? So I think that's more the issue around that misunderstanding of how what we hear about what's happening in the politics and what we read in the newspaper, does that really impact the economic and institutional fundamentals of the country or not?
Christoph, what's your take? What you read in the news, on the news wires, both locally and internationally, how much does that influence, do you think it influences investors' decisions for Africa when it comes to risk?
Unfortunately, it influences it massively. You know, when I read newspapers in France or in the UK or in the US, you never hear news about a great IPO, you know, coming out of the DRC or Tanzania, or an IPO of the drugs company in Uganda, or, you know, entrepreneurs in Kenya coming up with a great fintech company. What you hear about are the problems and the disasters, right? And so it's a question of better promoting the story. When good things happen, really making an effort to get that promoted. And then there needs to be, you know, I think, you know, and here I'm a bit preaching for my old employer, you know, Renaissance Capital. We, you know, there are firms like Renaissance Capital, like Helios Towers, that are fully focused on the continent, but are not being supported by companies and by, you know, by politicians in Africa in those efforts. And so when there is a big IPO and there's a big debt raising, the ones who will get the mandates are the Goldman Sachs or the Citibanks or the Morgan Stanleys that are not as committed to the continent. And that, you know, I would say is kind of an own goal in not promoting both, you know, the domestic players, but also the ones that are fully focused on the continent, and, you know, giving them a chance to really tell the story and the good things that are happening on the continent. The other point that I would make, you know, going back to your geopolitical question, is, you know, in geopolitics, size matters, right? And in order for Africa's voice to be heard, you know, regional players like the African Union and some of the regional groupings need to have a louder voice, because individual countries, you know, when going up against China, when going up against the US, when going up against the European Union, are just not powerful enough. And so the African Union, some of the regional bodies need to have a bigger voice in order to have a bigger geopolitical position.
Interesting insight from you and your thoughts, Christoph. Kojo, what's your take on this last point as we wrap up?
Yeah, no, I think it's a very fascinating question. I would like to I think, you know, post-COVID, we've obviously had BLM, Black Lives Matter, and I think it's all interlinked, because I think we have to go backwards before we can go forward. So to touch on Christoph's last point, we have smaller countries because we were historically divided by colonialism. It's the same people that colonized you that are writing the stories about your countries. So it goes back to my original point. You have to do a reset, because you're playing a no-win game. The same people that colonized you, but also control the illicit outflows that we don't talk about, that go out of the continent in its billions every year. It's actually more than FDI, the illicit outflows about the country. It still all comes from the same source. You know, the people that colonized you now control the media, the rights about you. So it's obviously going to be negative. because it's also in certain interests to keep that perception, so those that are benefiting from the status quo continue to benefit. So it goes back to my original point that if you don't do a complete reset, you're stuck in this no-win game. And I think realpolitik plays a huge role in everything that we see, and in terms of the ratings and so on and so forth. I think it's very, very political, and it continues to be exacerbated.
A great point. Thank you so much, Kojo. And finally, Michael Nderutu, what's your take on this, on the big elephant in the room, politics?
So politics is just a perception and a way of life. And unfortunately, as even what Kojo has said, is that some of the people that colonized us, they have to decide what to write and what not to write. Because for sure, I think what has been a learning lesson for everybody across the world is the COVID situation. So if you look at the impact of COVID in Africa, and look at the impact of COVID against now the developed countries. Now, if it was a political thing that was happening, what would you have ranked it? I think Kenyans or Africans really have done very well in terms of trying to do that. But they can never speak about Africa trying to fight COVID in the best way possible. No. It will never appear anywhere. So it's the same thing. So we have some political bickerings here and there, which they have not taken keen interest and invested with their researchers to actually understand, because probably that is our way of life, because politics is everywhere. Look at Brexit, how many PMs have gone through with it. They come, they disagree, they have to exit. But probably in Africa, that's not our style of doing things. We fight and soldier on, whether the guy is doing or not doing the right thing. So we really have to really understand because we can never be the same. So everybody, and like I said, we have to really do proper risk assessments of the political risks that are here. So the political risks that are in Africa, they are totally different from the US and whatever. So the investment banks, the investors have to really put a lot of effort. And my biggest parting shot will go to the credit rating firms. I think by them rating, giving around 20-something% to around 35% on political stability, I think that would be a way of trying to probably sway the results of the credit rating, and they would wish that they could adjust those measures so that they reflect the true signs on the ground of what is actually happening in Africa.
Michael, thank you so much, and I thank all my panelists. I'll thank all of you again, but just a quick 1 second, polling, well, I'm sure the result is coming through on everyone's screen. You can see that. The question, to what extent is there a sense of risk bias against Africa? The second and the third point seem to have a tie. 55%. Investors' bias is significant, but justified by poorer fundamentals, and investors' bias is significant and cannot be justified by fundamentals. That goes back to my question. Guilty before proven innocent, or innocent before proven guilty? Very interesting question. Everyone, thank you very much for contributing. Let me just say thank you once again to my panelists. Fulu Mudau, thank you so much. The Fixed Income and Currencies Officer at Deutsche Bank in South Africa. Christopher Charlier, former chairman at Renaissance Capital. Thank you very much for coming. And of course, Kojo Annan, the chairman and co-founder of Vector Capital, and the son of the late Kofi Annan, former Secretary General of the United Nations. Thank you very much, everyone. And Michael Nderutu, I'm not forgetting you, who is the Chief Risk Officer at ASA. Thank you, everyone, and our participants around the world. As we begin to wrap up, we can get all of this for our webinars and highlights from this event available on Twitter. You can go to at @ASA_Africa. That's the Twitter handle for ASA. Meantime, ASA is also very active on the continent in terms of liquidity, providing treasury solutions to whatever your transaction needs on the African continent. You can access their BFX products, and you can send them business payments. It's all cheaper, faster, and better if you go through tradefx.com. All of that coming to. Thank you very much, ASA and the rest of the team for putting this together, including new media and markets intelligence. Thank you, everyone. Do have a great day, and I'll see you next time. I am hosting Amofaye from Lagos. Bye for now.
Thank you very much.
Thank you, Bosan.
Bye, everyone.
Hopefully, thank you.